Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look at a new vol capture trade, our latest one on Gap Inc., the Gap stores, if you will, where some massive, unusual call buying sets up ideally for a vol capture trade to take advantage of a big jump in IV. So let's jump in and take a look. Here is the Gap D24 calls. Showing up on the scanner that I kind of created on the Thinkorswim website. You can see almost 85,000 contracts traded, by far the biggest unusual option activity. And here's kind of the scan, right, where I'm looking for decent volume that exceeds basically, if you will, the open interest. Most importantly, a jump right here, right, in implied volatility, which means it's aggressive buying, right? Which means someone is thinking maybe something may happen. Regardless, the price of the option goes up, and that's what we always look for. How much did it go up? Here's the IV, as you can see, pulled it off. So here it is, basically the 2.5 weeks before. You can see hovering right around that kind of upper 30, low 40-ish level. Then on Thursday saw a little move up, right, to 47.5. Then here's that huge explosion to Friday, right? And this is generalized kind of 25 delta calls and puts to over 50, right? So an enormous jump, the highest IV we have seen in a very long time. Here's that volume that we talked about. Almost 90,000 of the December options traded. You can see IV jumped almost 10% out in December. We're seeing the IV percentile now approaching 50, and again, compared to the historic volatility of 11, certainly fairly rich options. You can see call volume certainly dominating. Pulled off a different look at IV. Here is basically the 60-day, which be the December expiration, slightly out of the money calls and puts, 40 delta call, 40 delta put, right? You can see just kind of slowly moving around, maybe drifting higher. Then boom, when we saw that huge call buyer out in December, you see the IV just exploded. This is what we look to take advantage of. Very similar to our past two trades that worked out nicely in one day in ERO and Poet. You can also take a look at a different viewpoint. Here's that 60-day vol, now trading over 60 for basically the first time since the Liberation Day lows in the market, right? It was under 40 not too long ago back here, now over 60, so a big jump in IV. You can see implied volatility jumped up across the entire term structure as well. And we don't have earnings coming out until late November, so certainly have plenty of time for the IV to revert as well. So here's the trade idea we were looking at, right? So I pulled off on Thursday's close with a slight run up in IV that we looked at, right? Selling an out of the money December call and put strangle, right? So selling the $20 put, the $25 call. The stock on Thursday closed at 20.65, so the puts were closer to being in the money than the calls, well out of the money. And that strangle closed at $2.10. The IV, the average between the put and call, right at the 55 level, right? The delta on the trade, by selling that 39 delta put and a 25 delta call, you would have been 14 deltas net long. So certainly a bullish trade. So if the stock goes up, you'd expect that trade to be profitable. The strangle price, since we're selling it, to go down in price. Lo and behold, the stock did go up very nicely, right? 95 cents on a $20 stock. So basically just under a 5% move. But we saw that strangle jump up by 19 cents. Why? Because we saw IV explode by almost 5 vol points. So that huge jump in IV that we saw here and here basically made a trade that should have gone down go up in price, right? And that's what we like to see. We like to jump in and take advantage of that. So now selling that strangle, right? Selling the December 20 puts, which are still closer than the $25 calls as far as the current price of the stock, where it closed at 21.60, right? That strangle went up in price. The delta now on the strangle, because that call delta, right, went from 25 to 33, right, exploded higher, simply because, as we've talked about, jump in IVs tend to make deltas move towards the absolute value of 50, right? Especially on lower price stocks. So basically now the trade, for all intents and purposes, pretty much neutral, right? One delta net short, and that's at this high vol level. So certainly a fairly neutral trade, as neutral as you can be. So that's what we would jump in and do, sell that strangle for right around $2.29. So the smooth delta, which is basically the average of the delta before, right, where it closed at Thursday to Friday's close of -1, that smooth delta across that price movement of the 95 cents, it would have been about 6.5 deltas net long. And with the stock being up 95 cents, right, you'd expect the trade to gain a little over 6 cents. Instead, the trade actually marked down, as we said, 19 cents, moving from $2.10 sold to $2.29, right? So the vol capture, how much volatility you're able to capture by selling it, is roughly 25 cents. We're not factoring in theta, which is probably a penny, maybe two, simply because it's a one-day move here. I like to look at the theoreticals as well. So kind of pulled it off from now till a reversion back. So right now you're seeing that the implied volatility at these high levels, right? The calls theoretically worth $1 for the puts at 126. That equates right to that $2.29 or $2.30 area, right? And if we just have the IV revert back 3 vol points, right, it doesn't have to revert back anywhere near that 40 level. We're just looking for it to go maybe back below 50 by a small token generally, right? But if we have that IV revert by simply the 3 vol points, right, you can see the call theoretical drops 9 cents. The put theoretical drops also 9 cents, hence an 18-cent edge just by that 3-point IV reversion. We would probably look for some reversion, maybe a touch more to cover that trade and move on. So all we like to do, as we always say, is look to sell the rip. So we're looking to sell that huge pop higher, right? Sell that rip, and then when it dips back down, similar to our last trade in ERO, cover the trade, move on for a very nice short-term gain, all the while being very neutral, right? This is a neutral trade indeed. As we said, you're as neutral as can be, being one delta net short. So hopefully kind of walks through how we go about identifying trade opportunities here at Delta Derivatives. And as we always say, position size is important as well, because at the end of the day, trading is all about probability, not certainty. So find the edge, put on the hedge, position size accordingly, and get out when the trade moves against you to agree where the delta tolerance bands are exceeded. So until next time, as always, here's the good trading. Take care.